Welcome, everyone. It's a great pleasure to be moderating the last panel of the day for what was a wonderful conference until this point. And of course, we want to give it that last kick into the evening. I've got a really big panel, so I briefly introduce myself. I'm Ruth Wandhöfer, ex-banker, so I know the financial industry well, a researcher into blockchain and crypto technology, and working with a lot of fintechs. I have multiple hats. I'm here in my personal capacity to moderate, so I can say what I want. And I'd just like to introduce the panel by letting the panel introduce itself.
Okay, many thanks. Simon Seiter, Head of Digital Assets at Deutsche Börse. And I previously also worked at Commerzbank, so also coming from the rather institutional side and looking forward to discussion.
Hi, everyone. Impressed with everyone that's turned up here for the last panel at the end of the day. So Chris Aruliah. I head up banking relations for BitStamp. I've been at BitStamp a year now. Prior to that, I was with a company called Token.io. So I've been working with banks for roughly 15 years and banking relationships.
Hi, guys. I'm Pires. I'm VP for Crypto.com and heading up their exchange business as they've recently launched a new exchange. Prior to that, I was doing a very similar role at OKX, and prior to that, kind of more of a traditional working at ICE and S&P Global.
Good afternoon. My name is Herve Francois. I guess I'm the banker on the panel. So I work in a capital market since 18 years now. I did AlphaFit as a trader on FX swaps. Joined ING 8 years ago, 4 years in the blockchain team as an initiative lead.
And hi, I'm Chris Tyrer, former banker. So I spent 17 years trading commodities and managing commodity trading businesses before leading the digital asset project at an investment bank, and then joining Fidelity to run their European business.
Great. So we've kind of got a list of a row of people that have all somehow been involved with the old financial system. And some of them have made the jump into the new guard. So the title for our session is The Old Guard versus New Blood. How will banks interact with crypto markets? And I guess the question is, how can you interact with the new market if you don't understand the old market? And how can you provide a completely new outlook of a market to be created if you don't understand the needs of clients and incumbents? So we heard already in previous panels that the old rusty rails of the financial services industry seem to work well. The new rails might not be scalable yet. We heard that actually financial institutions have done a lot over the last 2 years, 3 years to get into that new technology game, to understand it better. We've got ex-bankers that now work for technology firms. And so I guess the question is, from the sort of 2016, 17, 18 proof of concept hype, experimentation, have we now started to see real developments, or have we got real challenges? So maybe if we first reflect a bit on the challenges, and then we can sort of go through the opportunity side. Who wants to start?
Sure, I can take that. I mean, so I was, running one of those projects back in sort of early, late 17, early 2018, and the narrative back then, if we remember, I mean, it felt like almost every 2 weeks there was another bank that, a story about another bank that was launching a crypto asset project to look into the opportunities. And fast forward 2 years, and nothing really has become of it. But certainly from the direct engagement with physical quote unquote crypto assets. And I think there's a number of reasons for that. I mean, I think that the first thing was that we entered a crypto winter, which wasn't particularly helpful. But I think also, the output from those projects really highlighted that this is completely different. There's a lot of technical complexity in dealing with digitally native assets such as Bitcoin. So, you need a brand new tech stack. You need new settlement systems. You need new AML and compliance programs. You need to put in place control environments. You need to, get more up to speed on operational security and so on and so forth. And there's a massive amount of execution risk around this as well. I mean, the banks are still suffering from, the brain damage of having been fined. The West top 20 banks were fined £264 billion from 2012 to 2016, and so that's created a real risk aversion when it comes to something new, and it comes to something around which there is, some execution risk. And so, this isn't really like sort of introducing the Kenyan shilling to another to an EMFX mandate, I mean, this is something that will go on a front page headlines. This will be on the front page of the FT. It'd be on the front page of the Wall Street Journal if, a bank decides to have a full-blown, crypto offering. And so as a result of that, the decisions necessarily need to be made at the C-suite level. It's the CEO who's going to be, asked to opine on this, and that in turn will probably go to the board of directors, who's going to go to reputational committees, further risk committees. And as a result, you're getting further and further away from the actual body of knowledge that has put forward these business plans. And so I think that it's really imperative, therefore, to have somebody at the top of the house that really sees this for what it is, sees the transformative potential of the technology and of the emerging asset in order to push these things forward. And I think that that's what we've been missing primarily from the banks over the last couple of years.
Yeah, talking about the bank, maybe I can echo with what you're saying. So ING has been in the space looking at DLT, blockchain technology, since 2014 already. So did plenty of proof of concept, 44, a lot of pilot, 8, like production-ready project, especially on tokenization of assets like HQLX. And I think we saw like the same move like around like 2016, where people were looking at the potential of the underlying technology. At the end of 2017 or early 2018, like incumbent was started to be interested about like these use cases on digital assets. And following like the summer on 18, where you got like a lot of STO, I think it just raised all like this appetite to see, okay, what benefits can we get from digital assets, especially about like tokenization of assets, not only asset-backed, but also like native digital assets, meaning like those would only exist on the underlying technology. So I won't like say the same thing in terms of challenges, but like the other things we see are like talents. I think the talent pool is still like a problem for people who try to work on that space. Education, internally, but also externally. We have to do a lot of effort like to educate people within our own company. And I'm not only thinking about like the C-level, it's also true for any single department in the bank, from like ORM, IRM, compliance, legal officer, and obviously with our client, because we're still like a client focus, so we need to discuss about this. So that's the two points. And the last one that will come, obviously, is regulation. That's been the one so always like slow you down in general.
Definitely agree with all of that. I mean, there's technical challenges for the bank, but looking at it from an exchange perspective, I think one of the challenges actually, and touching on the education front, is the recognition that banks are already participants in the market in an indirect fashion. So because their customers are already there. So customers are trading on exchanges, the market is growing, and we're seeing increased liquidity, coming into our market. So that's part of the education sort of task, I guess, within the bank and compliance. When we touch on that, regulation, yes, is one challenge, but educating compliance teams to actually understand how crypto markets work and actually that digital assets are far more traceable than fiat, using tools such as chain analysis, et cetera. So there's, a number of things, I think, there.
I think it really would benefit us as well as legacy traditional financial markets to actually start changing the narrative. It's not necessarily old guard versus new blood. It's essentially, we need to work together. We forget what gave birth to Bitcoin. It was a financial crisis. It was a crisis that essentially brought about questions as to how we can fix it, how we can fix the existing markets, what's wrong with it. Do we need more security? Do we need more regulation? Do we need more liquidity? Whatever the case may be, it's less about us versus them, but more, as you've all rightly mentioned, an education, right? We have banks with digital desks researching this stuff. Bank of England has been researching this for many, many years. Do we have the same? Do crypto desks have, a specialist from legacy? And then not just hiring them to build out systems and do a great job, but actually have someone researching those markets, that technology, and saying, how can we combine the two? It's really, in my opinion, really finding a very happy medium of working together rather than one replacing the other or one trying to do the other one better.
Completely agree. I mean, also as Herve has pointed out, like on HQLX, where we actually collaborated on, this was exactly the approach as we had something like, I would say, a minimum invasive approach, right? When we started with the whole crypto stuff, everybody thought you have to change the whole value chain because you can disintermediate everything. So you completely do a disruptive approach, throw away the old architecture and build something new. The problem is, if you have had a banking integration project already, think about how long it takes, how much resources it covers, only to replace one system within the bank. So, and now they wanted to replace every system within the bank, basically, and building something new. And I think this simply doesn't work because the world is more complex than the POC phase. Yeah? And so what we did actually was that we put another service on top of the existing infrastructure. So you use the existing interfaces, you use existing systems where possible, and only change what is necessary in the first stage as an MVP to get into production. And this is what we have done, like with this collateral management service, where the collateral stays within the actual custody accounts, but you put a service on top which tokenizes the right for these baskets and exchange them for short-term liquidity needs in terms of Basel III. So you have a very, very specific use case. It's a minimum invasive approach. You change only little things, and it's an additional service instead of trying to disintermediate everything at once.
And I think it's quite interesting because often there are two debates. One is all about investing in alternative assets, being the crypto assets. And we had a few conversations on panels about this particular point, where the market, as we know, is quite small. The solutions are proportionately scalable to the size of that market. And it's not really rocking the boat at the grander scheme of things. And the question of trust there is interesting because trust is resolved through the way the protocol operates, whilst the old world or the big world out there is still used to having intermediaries that you trust, as well as regulation that enforces intermediaries to behave in certain ways, which is, of course, why we have custodians and banks, et cetera. So I think we're talking about two different things, because the other question is, of course, how can we rethink the infrastructure for existing assets, existing regulated players, in order to improve balance sheet performance, in order to increase velocity of liquidity, unlock liquidity, even at a level of all assets when we talk about fractionalization, tokenization, et cetera. So I think there are two debates where the incumbent industry is starting to be inspired by what the new technology has delivered. And of course, we shouldn't forget that there's more research and development ongoing in that space. Yes, we have the Bitcoin protocol, but we have completely different consensus algorithm and distributed ledgers now that really can cater for the regulated market and can truly speed up stuff. And of course, when it comes to AML, indeed, Chris, we have multiple solutions, Chainalysis, CoinFirm, Elliptic, and I think one of the panelists earlier on discussed the issue of anti-money laundering and the fact that they have some providers they have to rely on because there's nothing better. We're starting to see more providers in the market, and then you can triangulate the data sets. So I think we have to be very mindful that in order to disrupt long-term to make the financial industry at large better, we actually have many pieces that are evolving, and we just need to puzzle them together in the right way. So, and Diana, that was also the point on bringing both sides together to collaborate, as opposed to be opposed to each other, right?
I definitely feel like we're at this point, and I guess this conference is an example of it, where we're crossing from that initial disruptive kind of phase, I guess, where we are blending traditional finance with, you know, the guys that have come into this space and innovated. And, you know, from the banks we talk to, and definitely to Herve's point, you know, banks are engaged in a number of projects trying to understand this. And, you know, there are institutions, mentioned a couple this morning, I think, Kevin, on the panel, Revolut and Robinhood, who serve the retail space. But you see, you know, just by everyone here, there's increased institutional interest in this space. And, you know, BitStamp, you know, the amount of projects that come across our exchange in terms of new coin listings, new projects, et cetera, is just phenomenal, you know, and that's the really exciting part of this, that, you know, we're starting to enter into a phase where traditional finance can, you know, participate, and that's when we start to see some, you know, huge growth.
Yeah, I think we already see a lot of partnership, like in terms of like tokenization of assets, like a typical tokenizer, like are now supporting like banks. So saw a couple of examples like last year. But now, like, let's face it, if our end client have a choice between using like a newcomer or using a bank, still feel more comfortable with a financial institution full stop. But I do understand like we bring like different things on the table. You need like a partnership because people are more nimble, like can work like with real innovations that does help. On the other side, we still bring like the regulatory approach first to be solid, having all like the risk assessment that come with that, and talking with regulators, which is valuable, I believe, to scale into that space.
Indeed. So how do we see, I guess we spoke about it before, legacy tech. I mean, I agree with you, we should identify where we can hook things on with minimal impact to the larger system. But it's true that all the banks are running on 40-year-old infrastructure, and there is a big question out there, how do we re-architect the data ecosystem, the infrastructure, and start moving to a new tech stack that is more agile and nimble and can be modified over time. And of course, using distributed ledger technology and those sort of new tools, APIs, etc., is an opportunity to start. Can we maybe see some slow migration to a new model with the right investment money? Because that's been something where people have been running away from a lot.
Completely agree. If I had the budget on DLT projects, which I had on digitization-only projects within the bank, building SQL-based systems, that would be very nice. Yeah, it's not the extent in our company at least. But I think the problem is when you come from a classical banking architecture and operating model, you have a monolithic architecture. So there's this one monolith, and it doesn't have even layers, it's simply there, and you can't really touch it, so you try to build interfaces that might simulate layers, maybe, yeah? So the problem is, you can't also split up the monolith, because it's a monolith, yeah? You can't split it up. So I think what is the approach we take is trying to build infrastructure components that replace maybe interfaces to core systems, that are already there in place, and thereby trying to build a new architecture step by step, actually, with new components to different use cases. And these infrastructure components must not be based on DLT. Some will, some may not. Mm-hmm. And the point is then there might be the point in time where you can actually switch from the old monolithic system to a more flexible system. But I think these big bang approaches are quite risky, and we have seen this in the industry. And at least also my experience from different companies was now that you don't really get a board commitment for the big bang approach. Yeah?
Yes, I can say risk appetite is keeping us all awake at night on boards, that's for sure. Do you feel that the risk appetite in terms of the governance at the board level is changing, I guess, on the one hand in terms of the infrastructural developments, and on the other hand in terms of crypto as alternative investment, and what are the...
Yeah, I think they're two completely different things.
Yeah.
Like I think in terms of crypto, it's going to be driven by regulation. What we've seen is that in jurisdictions where there has been very clear regulation, like a look at Switzerland, there's been a massive expansion in terms of various banks popping up offering crypto services. We've seen the same in Japan with SBI has its own exchange. All the banks are involved in some way, shape, or form. I read a report that since the German law change at the beginning of this year, that 40 existing banks have registered to become crypto custodians. So what we've seen is like very clear overlap where there's clear regulation. You see pretty immediate adoption thereafter from traditional finance. I think it's just that having that regulatory void is unhelpful. And so yeah, to answer your question, like on the other front, in terms of like infrastructure changes and improving efficiencies, like I think that is a very much more well accepted like transition.
I think we also see as well kind of very, very well-known companies in the traditional space already even kind of trying to help us along, right? It's not the first time that we've seen a traditional exchange helping a crypto exchange by, building out their tech and allowing them to build their exchange on top of it. And it's not to say that, that they themselves would completely replace their own tech, but I guess it's a green flag, right? It's showing that we're trying to understand what you're doing, and we're trying to push it along, and also in some way also, I'm sure, control it and kind of have an indirect involvement with it. But it's also how we kind of react to that as well, right? And how we can, speak to these guys and say, look, how then can we then implement this tech where you are, in your exchange? And how can we take bits from yours? And how can we possibly then merge and partner? And again, about merging and being partners rather than that exchange versus the other exchange, or NASDAQ versus Binance, whatever it might be, but instead partnering together. And we've seen that in many ways, right? But yeah.
But still, like, integration is a massive bottleneck. Like, sometimes we go faster just to do it, maybe because we're more techie and so on, but like it's faster for us to redevelop something from scratch than using a solution that you need to integrate, and it's quite like a daunting task.
But I think on the exchange side, it's also beautiful because you can learn from the incumbent exchanges in terms of those obvious things, BAU, testing, algorithms, connecting, implementing, because this is all the sort of general hard work of onboarding and connecting, which is, of course, similar in that new world. It's just the underlying way of trading.
Also providing tools that, these legacy traders, investors are also used to. Do we have economic scenario generators? Do we have backtesting tools? Do we have all of these things that these guys are used to having and using? Do we? Maybe not. Maybe we do. Does it work? Who knows, right? Whereas these guys, in legacy trading venues don't really have these concerns. There are multiple solutions where they can do that. And sure, you can create your own, crypto people, we develop, we do all kinds of things, but do we trust it? Do we know it? You know what I mean? There's just so many question marks around it. And again, it's an education, right?
And it's creating standards, right, over time. I mean, if they expect it to certain solutions, these are often also regulatory driven, like MiFID, best execution, et cetera. So you have to be able to mimic this in a way. But I think we heard earlier, the challenge of the crypto market is, of course, it's 24/7. It's an opportunity and a challenge. And I think it's a good challenge for the incumbent industry because you need 24/7 risk monitoring, right? You need cyber controls. You need operational resilience 24/7. You can't say I'm closing down on the weekend or I churn out a new API over a long weekend as a code upgrade. That's just not going to happen. So I think it's actually a really good push for the industry because it has to solve these issues anyway. And they happen to be...
We do it right now.
Yeah, exactly,
We have opening times for the trading systems.
Yeah, for example.
In the old world, it is quite fine. In the new world, it will be difficult, let me put it like that. And also, like you mentioned, risks and also educational part, I think also for the board, you have to try to show that there are new risk types that you didn't have yet. So, for example, just picking one, finality of transactions. Board members expect transactions within central systems to be final. In decentralized systems, or at least in most decentralized systems, they are not. So probabilistic finality is a new risk type for board members that they might intuitively not have on their agenda.
Yeah, that was one of my PhD papers, actually.
Yeah, okay.
Settlement finality in distributed systems.
Yeah.
You have to rethink it, and you have to create a new framework for assessing that risk. So it's a new risk, and it needs new ways of being measured.
Yeah.
And it depends on the underlying consensus, because obviously Bitcoin is very different to Ethereum or others, right? So that's exactly the point. Very good, yeah. Okay, what's on my list? In terms of other new technologies or data, how do you see... I guess the whole industry is being revolutionized with all of these new technologies. And it's not only about trading in a certain way, in a distributed way, but it's everything around it. And we've seen so many issues and risks with that connection to the fiat world and the exchanges we had earlier. Data sets are intransparent. We don't really know how much liquidity is in the market, how much trade is actually happening. So again, I think this is a case where new providers will come to the market to provide more transparency so that these markets can function. I guess the challenge is, though, if the markets are small, the economic opportunity is small. So we sort of need a combination of regulation and incumbents to adopt new tools so that there's enough business case for people to help with technologies to make the market safer. Yeah. Any views on that, or?
Maybe I will start to say, like, the role of the financial institution is we have to rethink it. Like a lot of those, like, for instance, like a clearinghouse, like custodian, like registrar, like a transfer agent. I think the technology can, like, do a lot of their work. So now I don't say like they become obsolete, but still, like, they have to think it a different way. May have value because regulators always want to face someone for those duties, obviously. But if you want to optimize, get all the benefits from the technology, it will be definitely redefined. And that also creates opportunity actually for people. So of course, if you're like the major player, you're kind of like cannibalizing your own market. But like if you're like a newcomers and others, that create new opportunities.
And this is actually another point on regulation, because of course the big financial institutions are so tightly regulated that a lot of the cost is spent on regulatory compliance. And if they are being disrupted because suddenly there's certain markets that will fall away and be taken by others, regulation has been a barrier, and now regulation is the constraint for them to no longer be able to play. So I think there's also a question around how regulation will evolve, because we will see providers changing role. We don't know yet how. And I mean, my view is banking is no longer what banking used to be. We see this already on the front end with the sort of smaller challenger banks. The question is what will happen ultimately to the balance sheet. That today is still the bank. If that changes, any prognosis of what could happen?
I think it's a tough one to answer, but in terms of, if we look at, without a doubt, banking is being disrupted. And how banks operate and the challenges they face, they're huge, not just in this space, but if we look at open banking and other areas. But, I think one of the things here that Diana touched on is partnerships, right? So certainly what we're, from our perspective in the space, we're looking for partnerships with banks. And there is an ability to partner to join up the best of both worlds. And I think, when we look at it from a balance sheet perspective, at the moment, we've got flow from banks to crypto markets. There are models that we can adopt where that flow doesn't have to happen. That can stay on balance sheet with the bank. The German banks now can be custodians. So, and that leads back to regulation. The regulator stepping in and clarifying how that should operate. So I think it's a combination of partnerships. So if we talk about old world and new world, it's more of a partnership, and then the regulator providing the clarity for that.
Talking about partnerships, any other examples of how you sort of, because sometimes new firms can be also small. I mean, it depends on how you partner. There's always a lot of concern on vendor risk and resilience, or completely new business models that people take time to get their heads around. But partnership has been the big sort of theme in the last 2-3 years across fintech in general, right? Do we see, I mean, maybe from an ING perspective, when you look at the sort of the crypto world, are you looking at partnerships, or are you looking more at the underlying technology, understand it yourself, and work with the incumbents in consortia like we've seen in trade finance? What are the sort of approaches?
You have different angle to it. Like we also participate, for like a development open source code, like a zero knowledge set membership, which is like accessible on Ethereum. So you interact with the community at some level, interact with like a partnership. So also work through our venture, ING Venture, for instance, developing together. But there's also another aspect you didn't mention, but which is just like collaboration between incumbents. A lot of those like use cases are still like a common problem that we try to solve for all of our customers, and now we have like this approach to work all together. We all bring like a different expertise. So I think it needs to be a mix when you work in consortium between like a newcomer who got an expertise, but also like getting like different people on the whole value chain basically. For the problem you try to tackle. So especially like around like all like digital assets, I think it's not like something standalone. Like you may focus, for instance, on I don't know, custody or safekeeping of those assets because it's a concern for your end client. But once you get this, you still need also to get like a safe exchange, and you need safe tokens, and so you realize that you need an issuer like exchange. You need the whole value chain basically. That's why I think like it's necessary to work more together with like do partnership, but also between incumbents.
Diana, you mentioned earlier on collaboration and the key to work closer together. How do you do that in your business today?
So we really, and I guess we see this actually, so in terms of DeFi, right, which is essentially FinTech 2.0. So I think crypto companies are focused by and large on retail base, right, which is usually the bread and butter, and we see this in banking as well, initially from inception. And I think it's kind of finding a happy medium again between the two, which is catering to your retail base, not neglecting your institutional base and not one or the other. So not just having a retail exchange and not just having an institutional exchange, but something that can work for both. So, in Crypto.com, you have an app, you've got debit cards, you've got all kinds of stuff that work for the retail base. And that was the bread and butter. And now it's time to launch the exchange, which essentially will be built from the ground up with the institutions. The retail base is, I hope, quite happy. It's a very large community, and they're happy, they're trading. There's all kinds of things going on to cater to them. And it's not to say that we're going to build strictly just an exchange just for the institutions, but if we're building it alongside the institutions, hopefully we can get it right. Rather than having an exchange that has been servicing retail, and now it's like, oh, let's get some big money on board, and let's bring you on basically, because we've got lots of volume, and we've got lots of derivatives, and we've got lots of margin. So, I don't think it's been done. I think more and more players are doing it, where they're launching exchanges that are very institutionally focused. I guess what we have, and we're quite lucky with, is that we already have the existing retail base that isn't necessarily linked to the exchange, that we can hopefully leverage, but isn't just all about one or the other. And again, it's this theme of partnership, whether it's with incumbents and new blood, whether it's retail and institutions, but it's really kind of respecting both and appreciating both.
What is the panel's perspective on financial stability? When we think about the tokenization of securities, we will automatically get transparency as to who's trading, how much it's been traded. Dependent on what type of ledger we ultimately use, but there will be a lot more transparency than what we had in the financial crisis and even now, because we start to see leverage going up again in pockets. We start see more risk taking, and it doesn't mean that we are better at managing that risk, because nothing much has changed since the crisis, to be honest, apart from draconian capital liquidity and leverage rules. But underneath, there's still a lot of stuff happening. Maybe some perspectives as to how maybe the market will embrace tokenization, or how the market will, certainly certain incumbents will avoid that because it will give them less freedom to be dodgy. Sorry, start with the German guy.
No, to be honest, I think, and even like having that heard from not only like a working level, but really senior level on all types of firms, I think there's a common sense there will be digital finance. And I think personally that DLT will play a big part of it. Whatsoever, digital finance and decentralized finance are things that are coming up. So for me, it's not the question like if it will come, but how do we deal with it and when will it come? And when we look at that, to be honest, I'm pretty sure that either we have already had our crypto crisis, or we will for sure, and I think that's rather the point, have a crypto or digital finance crisis. Because if you look at, and that's our whole story also at the Deutsche Börse Group, at the history you had basically securitization, which was a revolution back then in the 20s, and then you had the bubble, and then you had the crisis. And then you had electronic markets who literally replaced the trading floors, and what was coming, it was the .com bubble and the bubble of electronic markets. So now digital markets are coming, and I'm not an historian, but I would predict that it's quite possible that there will be a bubble of digital finance which will burst as well. The point is, however, the question is also what is triggering it. I think it is actually intransparency, because people have a faulty misconception about transparency in DLT. Yes, everything on the transaction layer is transparent, but the investment layer, look, what are you actually buying? That might not be that transparent. And people are starting buying real estate tokens. Have they seen the flat that they are buying? I don't think so. They simply buy it because only 100 euros. Yeah? And then you're starting building tokens of tokens and tokens of tokens of tokens. And then asset-backed tokens, asset-backed tokens AAA. And then you have next financial crisis in digital markets. Let's see and wait. The question is, can we maybe avoid the mistakes that we already made in other markets? Yeah.
Which is coming back to the design, and also question around rating. How do you evaluate? I mean, if you have these wrong incentives, that we had in the past with rating agencies paid by banks to rate. It's a bit like you pay a private school teacher and you would say, your child's really good in school, which is not the case, right? So how do we then learn from those mistakes and make sure that we design the right infrastructure? Because obviously Bitcoin is an experiment. That's not the infrastructure we talk about. We talk about foundational. And how can we create that?
Well, I think there's a difference between infrastructure and markets. Like, I understand what Simon's saying, but I think that, like, you know, the infrastructure on which things trade, transactions settle is different. You know, that doesn't prompt the mania. I think it's just the means by which you interact with it. You know, I think all of us can see that, like, tokenization is a real thing. It's happening. It's gonna come. I mean, Jeremy Allaire used to talk about the tokenization of everything, and I kind of like do think that that's the future state. How we get there, I think, is sort of slightly more difficult to call. But I think it's coming. It's just a more efficient way of transferring items of value. You get rid of. I think one of the key pieces that's been missing is central bank-backed digital currency, because then you have, like, both parts of the trade occurring simultaneously, right? And that's something that we've missed, because people just, let's face it, aren't going to use Tether to settle a security token. Or maybe they will at this point in time, but it's not going to entice traditional financial service businesses into the space. Now, as soon as you have that, you know, native central bank digital currency, that changes the whole. I think that's one of the key infrastructure pieces that needs to be put in place before you can really take tokenization to the next level. Because right now it's just, you know, people are tokenizing bits stuff here and there, but it's still very, very, very early stages.
Yeah. You have one side of the coin. I mean, everyone always forgets about the cash leg.
Yeah.
People talk about settlement, and all they do is saying, he's got the security, now she's got it, but how did they pay for it, and how did it settle? No one talks about that.
Yeah.
I think the central bank digital currency one is going to be very interesting, because obviously we all know in Davos they said now we're going to give out a framework, people are collaborating, there's a big debate around US dollar dominating global currency, or can it maybe be a basket of some other people? The Chinese are saying should be ours, so we're going to do it first. So I think the question will be how much fragmentation will we see as countries launch this, particularly in the G7, G10, G20, and can we get sufficient collaboration, because it's inevitably all geopolitics. I mean, it would be lovely if they would just see it as a stable coin to the extent possible. Unfortunately, it's highly geopolitical, but I agree with you. It's that stable coin element that we need truly defined.
Yep.
Yeah. Do we have any questions from the audience, by the way? I think we're running low on minutes. Any questions or comments? Any suggestions on how you think the old and new guard should work better together? I think we heard about collaboration, partnerships, education is a big piece that continues. Bankers have to be actually interested in how the stuff is evolving, otherwise they can't benefit from the opportunity. Yeah, we've got here, perfect. Yeah.
It's a quick one. I mean, some of these problems that you're mentioning, they're not new. They're old and they've been faced by banks before. For example, this idea of conditional settlement, that's Hofstadt risk. When we had currencies that moved for 2 days or 3 day settlements, that conditional risk was on the balance sheet before. So some of these things, although they're interesting in the margin of, you know, speeding up of process, they're not new. And they've already been solved, certainly from an accountancy point of view, if not a technological point of view. And one of the key things that people forget when they talk about regulation is accountancy practice, an international accountancy practice, which will influence the banks probably more in terms of how they handle and risk manage what's on their balance sheet than the actual regulations coming through in terms of what they have to do for compliance and KYC. What does the panel think about that?
I mean, completely agree that most problems that are faced in this new industry are still problems that we have perceived already in other asset classes. Yeah? And this is what I meant with maybe teach rather the new problems that are arising. I think the old problems we can really solve. There are like good ways that we have used in the past to solve it. There might be, for example, battles how to offload balance sheets actually within these kind of new assets. But I think that the real problems that we are facing are problems like finality, for example. Yeah? And finality can be a structural problem. Also then if you look for structural systemic risk, because I think the technology in total is a technology that might reduce systemic risk, for example, if you reduce settlement time. But finality could be a systemic risk after all. And then you have geopolitical questions going inside, as you mentioned before, like both for the cash side and for the security side maybe, or for the underlying infrastructure as it is public, because, for example, taking accountancy as a broader picture into account as well, if you have a public infrastructure, you don't have anybody to sue. Yeah. So who am you suing? Yeah.
That's a minor point from that point of view, but looking at systemic risk, currently we've got a derivatives market which is nominal value in excess of trillions that go through a year. And yet we've got clearing houses and exchange on there that have a particular type of counterparty risk because they're owned by the members, and there's a race to the bottom in terms of being able to charge for those services and the margin calls. But that's accepted. That's almost too big to be able to solve in the current financial system, so people just get on anyway. You know, why are we translating this and looking at this asset and saying it's a new set of problems? They've already been encountered, and some of them have already been accepted by the financial system. It creates a hesitancy that really shouldn't be there because it's just another currency. It's just another asset. The systems are already set up to add a new product.
Coming from a corporation that has a clearinghouse and a CSD and spot markets, agreed, we see a lot of problems that are the same in other asset classes, but there are really also new problems. And for these new problems, and I think this is the finality, for example, this is the systemic risk of the underlying architecture of a public chain, for example. If somebody else has solved it, please let me know. but we haven't. For the other problems, completely agree, and that's why we are trying to reuse also infrastructure components, because, for example, efficient trading, we already have infrastructure for that. We don't need DLT for that. We need DLT for the custody then, but the custody will be somehow also the settlement system if you execute a physical trade, basically, on crypto, and then you have the finality problem, for example. So I think there are still some new problems that are not solved.
Yeah. I think the challenge is it's a whole ecosystem, and it has many components. It's not only about the trade, it's not only about the transaction layer, it's about the quality of the asset, the rating, it's about the execution speed, the liquidity, the financial impact on the balance sheet. I totally agree with the accounting standards. Obviously, it's a big question specifically on crypto assets, which hasn't been clearly defined, but it could be on, is a tokenized asset in general now different to what it used to be? Maybe you just say a Siemens share is still a Siemens share if it's tokenized, so you could sort of apply the same principle. But of course, there has to be global standards and consistency, otherwise people will not be able to recreate this new system. I was told to wrap up. Yeah, so I would like to invite everyone for drinks now, because that's what you're waiting for. So I would like to thank my brilliant panel for taking us to the last mile round and for a great conference.